Right now, the stock market is sitting at absolute all-time highs.
Yeah, it really is.
And the fear index is completely collapsed. And, retail investors are basically celebrating what feels like this permanently euphoric soft landing.
Right. Everyone is just incredibly relaxed.
Exactly. But there's a mathematical model, one that actually successfully flagged the 2008 financial crisis and the 2020 crash before they hit the mainstream. And right now it is currently screaming that the biggest AI stocks in the world are caught in this localized Category 5 crisis.
Yeah, it's a massive red flag.
So welcome to the deep dive. Our mission today is to look under the hood of a highly sophisticated quantitative tool known as the HMM regime detector.
Which is such a fascinating piece of tech.
It really is.
Yeah.
And in the institutional quant world, you'll actually hear this referred to as the VWAP for volatility.
Right, that's the common nickname.
Yeah. And for you listening today, we're parsing through a massive stack of hard data. We're looking at 60-day look-back metrics, 26 years of historical training data, and these recent SEC 13F filings that just revealed a $1.1 billion options bet by a famously contrarian investor.
It's a setup that, frankly, just defies basic human intuition.
How so?
Well, I mean, you have the S&P 500 trading seamlessly above 710, right? But underneath the surface, the actual mathematical engine of the market is registering a structural failure.
A structural failure while we're at all-time highs.
Exactly. And, we aren't looking at opinion pieces or narrative analysis today. We are looking at a purely dispassionate statistical framework that maps the hidden states of market volatility.
Right. And you mentioned earlier that this model just cuts through all the static. So let's really look under the hood here.
Let's do it.
If I'm building a regime detector from scratch, what is the actual engine powering it? Because you call it an HMM.
Yeah, so HMM stands for Hidden Markov Model. And before we even try to apply it to finance, I think it helps to understand where this math actually comes from.
Yeah, lay it out for us.
So hidden Markov models were heavily developed in the 1960s and 70s, and they were primarily used for speech recognition and then later on for DNA sequencing.
Wait, really? Speech recognition?
Yeah, exactly. The underlying principle is that you have this observable sequence of events, so sound waves hitting a microphone, or in our case, daily stock returns and options premiums.
Right, the stuff you can actually measure.
Exactly. But those observable events are being generated by a hidden state that you cannot directly measure.
Okay, let me make sure I'm following this. So when I speak into a microphone, the observable event is the actual acoustic frequency, right?
Mm-hmm. Yes.
But the hidden state is the actual word my brain intended to say. So the algorithm basically has to guess the word based on the raw frequency.
Precisely. That is exactly it. And it does this using what's called the Markov property.
The Markov property. Okay, what is that?
The Markov property basically states that the probability of transitioning to the next state depends solely on the current state.
Solely on the current state.
Yeah, it completely ignores the entire sequence of events that preceded it. It is inherently memoryless.
Wait, hold on. You're saying the market has no memory?
Mathematically speaking, yes.
Because that contradicts almost every technical analyst out there, I mean, anyone looking at a 200-day moving average or drawing Fibonacci retracements is operating on the assumption that the market's history explicitly dictates its future.
Right, and that is the crucial distinction here. And honestly, it's why fundamental and traditional technical traders often get completely wiped out during these structural breaks.
Because they're looking backward.
Exactly. The price might have memory because humans trade on price and humans have memory.
Sure, we remember what we bought a stock for.
Right. But the volatility regime, the actual structural state of risk in the market, that is vastly better modeled as a Markov chain.
Okay, so it's calculating the present risk.
Yes. The model calculates transition probabilities. What is the mathematical probability that a market currently in a trending state transitions into a crisis state tomorrow?
I see.
It doesn't care if it was in a ranging state 3 weeks ago. It only evaluates the pressure matrix right now.
So we are categorizing market behavior into 3 distinct states or regimes, ranging, trending, and crisis.
Correct. Those are the 3 buckets.
But how do we validate that this memoryless statistical model actually works? I mean, without just curve fitting it to past crashes. Because, anyone can build an algorithm that perfectly predicts 2008 if they build it in 2009.
Which is the cardinal sin of quantitative finance, right? We call that data snooping bias.
Right, exactly.
So to prevent this, the HMM relies on a really rigorous methodology called walk-forward validation.
Okay, walk-forward validation.
Yeah. When we say the model was trained on 26 years of data, we don't mean we just fed it the last 26 years and optimized all the parameters to look brilliant in hindsight.
Walk-forward validation basically means it has to eat its own cooking in real time, right?
Exactly. You train the model on a block of historical data, say 1990 to 2000.
Okay.
You lock the parameters. Then you literally walk forward and have it trade or classify the year 2001 completely blind.
Oh, wow. So it has no idea what 2001 looks like.
None at all. You record the performance, then include 2001 in the training data, lock the parameters again, and walk forward into 2002.
So the model is never allowed to peek into the future.
Never. When it assessed the market in, say, February 2020, it was using the mathematical baselines established up to that exact day.
Okay, so it's robust.
Yeah.
It mathematically prevents that hindsight bias.
Very robust, yeah.
Let's get into the mechanics of how it actually reads the tape then. We know the Markov chain is determining the transition probabilities between ranging, trending, and crisis.
Right.
But what are the actual inputs here? Like, how are we measuring the acoustic frequencies to, use our microphone analogy from earlier?
So the classifier relies on a dual input architecture, and it's focused entirely on volatility.
Just volatility.
Just volatility. The first input is realized volatility, or RV, and that's calculated over a 60-day look-back period.
Let's define RV mathematically for a second here, because, people throw the word volatility around as a synonym for fear.
Yeah.
And that's just not accurate.
No, it's not.
Realized volatility is really just this standard deviation of logarithmic daily returns, annualized.
Correct. And we use log returns specifically because they are time additive and they handle compound growth way more accurately than simple percentage changes.
Got it.
So the 60-day RV is a pure backward-looking measurement of dispersion. It's asking how wide is the distribution of daily price movements over the last 2 months.
Right. It doesn't care if the stock went up 5% or down 5%.
Exactly. It just cares about the magnitude of the swing.
So it's basically measuring the actual footprints in the snow.
That's a great way to put it, yeah.
But realized volatility is looking backward. And the HMM needs to model the current hidden state to understand where we are going. So what is that second input?
Second input is implied volatility, or 8phi.
Okay.
And actually, more specifically, the model measures the spread between implied volatility and realized volatility.
Let's slow down here for a second, because this is the entire key to the engine, isn't it?
It absolutely is.
Okay, so for you listening, implied volatility is derived from the options market. It's reverse engineered from the Black-Scholes model.
Right.
When you look at the price of an option, Black-Scholes takes the stock price, the strike price, the time to expiration, the risk-free interest rate, and then it spits out a theoretical value.
But the real-world options market doesn't trade at the exact Black-Scholes theoretical value.
Because of supply and demand.
Exactly. Supply and demand dictate the actual price. So market makers have to adjust the price of the option based on demand. And if we take that real-world price and plug it back into the Black-Scholes equation, leaving volatility as the only unknown variable we can solve for IV.
Okay, so implied volatility is essentially the market maker's mathematical expectation of future variance.
That's it. It's what the house is charging for insurance.
What the house is charging for insurance. I love that. Now, you mentioned the spread between IV and RV, the volatility risk premium.
Yes.
Because historically, implied volatility trades at a premium to realized volatility. Like, market makers aren't running a charity, right?
Certainly not.
They charge a markup for taking on the risk of selling you options.
Yeah.
So if IV is always slightly higher than RV normally, how does the model know when it's an actual crisis versus just normal market maker markup?
That is exactly where the HMM's emission probabilities come into play.
Emission probabilities.
Yeah. The model isn't just looking for IV to be higher than RV. It is looking for the structural relationship between the two to completely deviate from the historical baseline.
Oh, I see.
It's analyzing the actual shape of the volatility surface.
Yeah. Okay, what does that look like in practice?
Well, when the spread between IV and RV expands violently, or when the skew of the options chain changes meaning, out of the money puts suddenly become exponentially more expensive relative to at the money options.
Right.
When that happens, the emission probabilities shift.
So the market makers are suddenly charging fire insurance premiums while the house isn't even smoking yet.
Yes, exactly. The market makers, who have to constantly delta hedge their exposure, are actively pricing in forward risk.
Because they have to protect themselves.
Right. They are mathematically preparing for a storm. Now, to connect these observable inputs, the RV and the IV spread, to the hidden state, The model uses an algorithm called the Viterbi path.
Viterbi paths. Okay, I actually know this one. This is a dynamic programming algorithm developed by Andrew Viterbi, originally for decoding convolutional codes over noisy digital communication links.
That's the one.
But how does it decode a noisy stock market?
Well, dynamic programming solves really complex problems by basically breaking them down into simpler subproblems. And it stores the results so you don't have to compute them again. So the Viterbi algorithm looks at the entire sequence of observable volatility data up to today. And it calculates the probability of every possible sequence of hidden states that could have produced this data.
So it's looking at like Monday, Tuesday, Wednesday, Thursday, Friday, and saying, what is the mathematical likelihood that Monday was trending, Tuesday was trending, Wednesday was crisis, Thursday was crisis, versus some other combination?
Exactly.
Yeah.
And it finds the single path, the Viterbi path, that has the maximum a posteriori probability estimate.
Wow.
It essentially isolates the most statistically likely sequence of hidden regimes. It maps the observable data to the hidden reality.
Okay, let's anchor this in the current broad market, because if we look at the S&P 500 right now, the Viterbi path seems to be pointing to absolute tranquility.
It really does.
I mean, as of mid-April 2026, SPY is sitting at an all-time high of 710.14.
And its realized volatility is sitting at a very calm 18.5%.
Which is incredibly low.
It is near a one-year low. Because of this, the Viterbi algorithm has confidently placed SPY in a trending regime for the last 12 sessions.
So it sees no immediate danger.
Right. The RV is low, the IV is relatively compressed, and the volatility risk premium is sitting well within normal structural bounds.
So the algorithm is acting as a completely dispassionate referee. It sees SPY moving up slowly and steadily, standard deviations are tight, options pricing is relaxed.
Yep.
And so the hidden state is trending. I mean, this is what makes the VWAP for volatility, right?
Exactly.
Just like the volume-weighted average price tells day traders the true institutional price action by cutting through the noise of tiny retail trades, the HMM cuts through the noise of financial media panic.
It doesn't care what the talking heads on television are predicting for next quarter. It just reads the tape.
Right. But knowing how it classifies a calm trending market is really only half the equation here.
Yeah, the true value of the regime detector, where it really proves its worth to institutional quants, is how it handles state transitions.
The moment it flips.
Exactly. The exact mathematical moment the matrix flips from trending to crisis.
Okay, let's examine a transition in action then. Walk us through the March 2026 tariff crash.
Yeah.
Because this was a brutal, sudden shock to the system just a few weeks ago.
It was. And it is a phenomenal case study of the Viterbi path in action.
Walk us through the timeline.
So on March 19th, SPY was safely locked in a trending regime. Price action was climbing, RV was low.
And the narrative on Wall Street was just completely bulletproof. Everyone was buying the dip.
They were. But the underlying options flow started to mutate.
Mutate how?
Well, on March 25th, the model detected a critical state transition. The realized volatility hadn't exploded yet, The actual daily price movements of the SPY were still relatively contained.
Okay, so price was fine.
Right. But the implied volatility, specifically the skew on out-of-the-money puts, began to drastically disconnect from the realized historical volatility.
The market makers were suddenly pricing in severe tail risk.
Exactly. The emission probabilities triggered,
Right.
And so the Viterbi algorithm recalculated the matrix.
And the regime detector violently flipped SPY from trending into crisis.
It did.
But the actual market hadn't crashed yet.
Right.
Right. That transition to crisis occurred 6 full sessions before the worst of the massive sell-off actually hit the headlines and the retail accounts.
That's right.
6 days where the mathematical model is flashing red and the humans are still standing around talking about how resilient the economy is.
6 full days of lead time. And what followed was a violent structural reversion.
I mean, SPY crashed 10.4% from its high. It dropped from 738 down to 632.
And the VIX, the broad market fear index, spiked from 19.2 to a peak of 31.05.
So the model caught the volatility compression just as the pressure was building up underneath the surface.
It saw the strain.
Now, here's where we have to be incredibly careful, because I have to play devil's advocate and push back a little.
Go for it.
You're saying the math saw the transition a full week before a massive 10% drop. To a layman, this sounds like a crystal ball. Like it sounds like the algorithm basically predicted the future.
I get why it sounds like that, but it is absolutely not predicting the future, and frankly, thinking of it that way is dangerous.
Okay, clarify that for us.
The HMM did not know the word tariff was going to dominate the news cycle 6 days later. It did not read a geopolitical wire.
So what was it actually seeing then? Why did the